All right. Welcome. Welcome. Thank you so much all for joining us. We're really happy to see you and hope you get some good information from this webinar this evening. We're going to get started with the title of our webinar is Managing Cash Flow and Building Wealth in Veterinary Practices. And Nicole and I will be presenting two different parts of it. I'll be talking about the cash flow, and Nicole will be talking about building wealth. Nicole is with Morgan Stanley, and allow her to give a more detailed introduction later. A little bit about me. I was in private practice on a regular, traditional CPA practice since 1991, and then merged with another small practice in 2013. And last year we sold the bricks and mortar, and I went into a virtual practice providing advisory services for solely veterinarians. I've worked with a lot of small to medium sized businesses throughout the years and found a real love for working with veterinarians. So I decided to concentrate in that area. I did a lot of advising and tax work with different practices, and I found it was very rewarding. So that's the direction I'm taking. The photo that you see here is myself and my heart horse, Poet. I'm also an endurance rider, and I've ridden internationally since 2011. And last year I was in the World Endurance Championship in 2024. I really find that my sport actually aids in my business because on a daily basis, I think horses make us humble, and we have to plan and chunk things down, especially when we're riding 100 miles, to take one loop at a time. And that's what we do in business is we chunk tasks down so that we can manage them and make it work one piece at a time. I just want to draw a reminder that anyone that would like to put a question out, please jot it in the Q&A section and we'll answer in the last 10 minutes. I'm going to talk for about 20, 25 minutes, and then Nicole will take over, and then we'll open it up for questions at that time. So as I get started, I'd like to just go through just some definitions, some background, because I know there's some misconceptions and, to accountant-like people like myself and so forth, it's straightforward, but on a lot of small businesses and practices that I've worked with, there's some confusion between what defines cash and how to measure cash flow and how to make sure that we're planning appropriately for cash flow. And so, literally, cash flow is the movement of cash in and out of the company's accounts. And we track the inflows, we track the outflows, we look at the change in cash, and we compare that to the beginning cash and come to an ending cash balance. And we usually look at that on a monthly basis, and I'll show you what a projection would look like. That change in cash should not be confused with net income, which is truly the revenues and expenses. The difference between the two comes to net income. And cash flow can have some other dynamics coming into it. You can have loans coming in, you could have owners putting money into the business, and conversely, you could have debt payments and you could have payments out to the owners. And these are some of the things that are not captured when you're looking at revenues and expenses. So I just want to make sure that that is not confusion and that revenue does not equal cash flow. Because I've had a lot of people that say, well, I look at my profit and loss and the number at the bottom should be the cash in the bank. And that's not going to be the way it is. So I want to show you the keys to look for where to track that cash flow. The other thing I wanted to talk about was liquidity because it's really the measure of how quickly an asset can be converted to cash. And cash obviously is the most liquid. Accounts receivable, which are when you bill a patient or a client and they are set to pay you back at some point, usually hopefully quickly, if not within 30 days, that's a highly liquid asset. Inventory is also considered a liquid asset as well. But cash is really king because if we run out of that, then we have a real problem. On the left, if you'd like to take a look at the cash conversion cycle, just to have an idea of sometimes when you're um, going into business, let's say it's either the beginning of the month, the beginning of a business venture, whatever it is, you start out with cash in the bank. And then you start expending for supplies or for labor or whatever the expenses are. And some of those turn into accounts payable, which are due in net 30, let's say. You pay the accounts payable, and then very often the sale occurs after you've had these expenditures, which may for the most part, become cash because veterinary practices should be paid at the time of service and not necessarily incur accounts receivable where you have billed someone that needs to pay you back. And so there should be a nominal amount of cash accounts receivable that ultimately gets converted into cash. The other part of that is the time cycle in this, and that's the problem because as you're going through the cash conversion cycle, it doesn't necessarily mean that it's gonna happen as quickly as you need. You might be depleted before you actually have the cash coming in. So that's the value of actually running a projection to see where your cash is going, and I'm gonna show you how to what that looks like in a minute. Also, I saw a really good analogy, and it said that revenues are akin to water, which you can live without for a few days, but cash flow is like air because without it, you die. So the next is what are some of the veterinary practice cash flow challenges? Because even a very profitable practice can run out into cash flow shortages. And honestly, while I was in business, I saw people that were extremely profitable and growing like mad, ran out of cash and ultimately had to file bankruptcy. So this is really the area that we need to concentrate on because in a small to medium sized business, you just can't continue without it. Some problems you might run into is if you have seasonal business and you have unpredictable revenue cycles, or you have high payroll, and in a service industry, that's going to be a challenge. Or you may overrely on credit lines or other types of debt. So that's some of the common problems. And we've had instances where vet practices ran into challenges when they did not do any cash flow planning. They had accounts receivable that was sitting out there, but they didn't, either chase it down or get paid by it. And I know that's very onerous to work on that, but it's got to get converted to cash to make it worth it for you. Or excessive reliance on short-term debt. So our next is about cash flow forecasting and some of the pitfalls that you might run into. So here's where we're going to talk again about the inflows of cash, the outflows of cash. Inflows are your revenues, which are based on operations, your loan proceeds. Let's say you have a line of credit and you're able to draw down some money on that line of credit, or owner contributions. And that's all money going in. And then out, you have your fixed expenses, you have your payroll, you have your operational expenses, you have your debt payments. You may also have repayments to owners or people that have lent you money. So what happens is you want to start with your beginning cash and you want to project those cash shortages and plan accordingly. You should actually ideally have about a 3 month reserve of operating expenses. And I don't want you to panic on that because it's not necessarily the gross expenses in the business. We look at that on a more defined, detailed basis and say, okay, if you suddenly had no income, what would that look like if you had to go to the bare bones of expenses? And we make sure we look at what that number generates. But some of the problems that small businesses have run into, and I haven't really run into this with many veterinary practices, but one of the items is kiting payroll taxes. And that's when the owner is paying payroll and delaying paying the payroll taxes, or withholding them, not paying them on time, or running into challenges with the IRS and having fiduciary penalties, payroll tax penalties, and it can cause real problems for the business and the owner. Sometimes small businesses and practices overuse debt for operating expenses. We talked about having a line of credit and having the ability to rely on that as you need it. As long as you draw things down, you draw money down, you pay it back, we're fine. But if that's consistently rising and without being repaid, then you're running into areas where you need to really look at where you can conserve cash. Failing to pay the owner, this is a real key area. A lot of veterinarians and small business owners will pay themselves last. If there's money left over, we are going to, take a payroll, or we're going to take a distribution, or whatever method based upon your entity is. And that's not the way it should work because ultimately that ends up depleting your own reserves. And if the business is running into a position where it can't pay you and you need to maybe go for financing, then you are not in a good position to apply for that financing. So this is an example of a cash basis budget and a forecasted cash flow. And this is the this is the format I like. Down here in the green is more of the cash flow part of the uh, spreadsheet. And what I do is I look at the operation sides, the income, the expenses, and come to my net profit per month and look at that in comparison to my starting cash. And then I added in loan payments. That was the only thing that I added in for this example. But you might have other non-cash items in the budget, such as depreciation. We might have loan proceeds. We might have investments or distributions with the owners of the business, or you might sell or purchase up an asset, and that's going to either consume cash or it's going to maybe generate cash. And obviously, we don't want to be selling our assets, to run the business. But sometimes that happens when you're replacing an asset. So these are the ins and outs that we want to look at the bottom. And what I want to draw your attention to is that the first couple months, December through probably March are really tough months for this practice. And this is a totally fictitious practice, just so that you know. And at the end of January, the cash is real low to 12,000, goes to 3,500, and that 12,000 will go to the next month and the flow down and so forth in each month. You don't want to get into the situation where your overall cash is below a reserve that serves your business. If we looked at just operating expenses and cost of goods sold for this business and said that's the number we want on hand, the calculation would be about 200 to 250,000 to have in as a cash reserve. And that's assuming again that you would be paying everything out without any type of income. And you're certainly not going to do that, because if you're running into a situation where you have absolutely no income, you're going to start cutting expenses. So that's what we would want to look at to really define that reserve. So we've gotten past the point that, okay, we have a reserve, or we're starting to put a reserve in place, and we want to grow. And sometimes, as we were talking about with the cash conversion cycle, as we start to grow, there's more money outflowing than there is inflowing. And the actual realization of the revenue is not necessarily going to be maybe for a couple weeks, months, or 6 months down the line. And we need to make sure that we've mapped that out. And back on the original example here, I left out any type of loan proceeds because we really want to look at where is the problem lying and then plan accordingly. And I'll tell you that what we want to do too is put a line of credit in place with a bank. The bank is going to give you a more favorable rate, and you want to do that well in advance of the time that you're going to be looking at a low cash balance, or if you don't have the adequate reserves, because the bank is more likely to actually lend you money when you don't need it, and they're not going to lend it to you if you're in a last minute dire situation, or it may be very costly with a high interest rate. So the next thing is to prevent cash shortages, as we talked about, is the 3 month reserve and the using their line of credit. And the other thing is to look at your liquidity measurements, which relate back to the balance sheet. And we could go through that at a different time, but it's basically looking at, do you have enough liquid assets to offset your um, current liabilities, your expenses that are going out? And that value should be greater than one. In other words, the liquid assets like cash and accounts receivable, inventory, and things like that should be higher than your accounts payable, your payroll taxes, and all those expenses that you have to pay out, on a current basis that's due every month. So, what is good debt versus bad debt? If you are choosing to grow and expand, and you have to take on a loan for that to work, or maybe you finance some equipment, that's not necessarily bad. That's actually a good thing, because you're moving upward, you're planning forward. But if it turns out that you're using debt, or as I said, your line of credit, where you're continuing to use it and you're not paying it back down, that's not the direction that you want to go, and that we usually say that it's bad debt. And with debt, you really want to protect your credit score, because you, as the business owner, if you go to a bank, they're going to ask that you guarantee the loan. They're going to look at your credit rating to make sure that you're eligible for the loan. However, if it is truly business debt, or a business credit card, that is not supposed to ding against your personal credit score, even though they're going to check it to make sure that you are a good, credit risk. So make sure that all debts are paid timely in and outside of the business. And this is again another reason to really monitor cash flow, because you want to say, hey, this debt is going to be due whether I have income or not, and make sure that I'm able to pay it. And you want to not use too much credit, and you want to separate your business and your personal credit cards. And I'll tell you, it's a real challenge sometimes. And I started my practice 30 years ago doing all of the wrong things. So I'm actually talking from experience, where it might be challenging to say, hey, I'm going to use my personal credit card. And then it has a spiraling effect because it, changes your credit rating. It's not a good way of financing a business. And I've seen small businesses do this, and sometimes in the short term it works out, but for the long term, really, it's better to avoid that. And also, that business credit card is not, again, supposed to be on your credit rating. So now we've gotten through, where you're tight on cash, you have to monitor it really closely. You have experienced growth and you have good cash reserves. And now we're looking at a situation where we actually have excess cash on hand, which is fabulous. So now we have the decision to make. Do we pay off our debt, maybe some high interest debt loans? And, what I do is I tell people to look at the interest cost on that debt. And let's say, for example, it's a 10% interest on that loan, and the effective tax rate is 15%. It would make the net interest expense to about 8.5%. Because what happens is, on the business, you get to deduct that interest, which ends up saving you taxes. So you want to kind of look at what that value is and calculate what that effective interest rate is. And then say, hey, could I take that 8.5% rate, and could I take it somewhere else and get a better return on my money? And if that's not true, then yes, it makes sense to pay off that debt. Or you might be in a situation where, you know what, I do want to pay off my debt, but I'm a little bit nervous about doing that. Let's set up a sinking fund where, okay, we already have our cash reserves, which, by the way, Nikki can tell you where to put those cash reserves so they are earning some interest for you. But perhaps I want to create something that's in a money market or a CD that's going to look for a future purchase of a piece of equipment, or you might decide to pay the debt down at that point in time when you've created this reserve. The other way to invest in your business is to buy that equipment or to upgrade your equipment. It may be that the repairs and maintenance on a current piece or what you have right now is, too costly and it's more inefficient. So it makes sense to put your investment of that excess cash back into the business by buying equipment. The other thing we can think about, and this is not ordered in priority, by the way, because this is really based upon the goals and desires of the owners of the practice. But you might be in a situation where, let's look at bonuses or implementing a retirement plan if one is not already in place. And I really suggest that no matter what level you are, you should start a retirement plan. But that's a conversation for an entirely different time. So we won't go down that rabbit hole. But let's look at, okay, do we want to invest in our staff? Because in veterinary medicine, our staff is irreplaceable in many respects. And it's probably one of the biggest challenges that I've heard, especially when I'm doing monthly coaching, is that, we're having these issues, or how do we increase retention? And, how do we get our, staff working together and working efficiently and so forth? And sometimes really acknowledging them and financially rewarding them is also very advantageous. We might want to purchase an inventory of things that we know we're going to need in advance, if we can buy it at a good discount or it makes financial sense. It might be better to have it in the bank earning interest if you don't get the decent terms on it. And obviously, you want to look at things that are not going to go off the shelf or perish or things like that. And then finally, I would actually call this one last, is to look at owner distributions, because you can get a great return of investing in your business when you really look at the bottom net income and look at that in comparison to what you're putting into the practice. Your return on that investment can sometimes be higher than, putting the money elsewhere. But at that point, when we do have the excess cash, is to look at owner distributions and to say, okay, we're already paying the owners good salaries. Do we look at what type of distributions may make sense for them, or bonuses or things like that, depending upon the type of entity that you're operating in, to take a look at putting the money out to the owners, and then the owners can take that money and invest it. So you want to try to do a balance between these items. I personally suggest that if you're going to do stock and bond investing, do it outside of the practice and retain that cash, because if you if you need to use it, you want it available to you. And you may not have the time to be able to make up a downturn in the economy where stocks go down and you'd have to wait for them to come up to get your true value out of it. So that would be my one suggestion. So we've weathered all of the different aspects of um, cash flow. And once cash flow is really well managed, then we look at how to invest that and excess cash into long-term wealth. So Nikki is going to talk about that in a second. This is my opportunity to say thank you very much, everyone, for coming in, showing up. I know this is a high level kind of analysis of cash, and there's a lot of different intricacies that could go into it. But we could talk about that more on an individual basis if that made sense. And I do want to offer 2 free copies of my new book, which is The Vet Advisor. Are you running your business or is it running you? And I hope it's not running you. But if it offers good advice for veterinary practices, let you know what type of services we're providing, also tax tips, business tips, looks at SOPs for standard operating procedures for employees, and has lots of information. If you'd like a brief overview for free, there is a download on my website, and I have the link on this page. And that you can bring down the summary. It's actually an abridged version of the book, and would give you an overview of what we're going to be talking about in greater depth. The other thing is I'd like you to look for me at AVMA or AEP conferences this year in 2025 in July and in December. I will also be sending these uh, oh gosh, slides. I'll be sending the slides out to everybody. Nicole's presentation will also be emailed to you. So you'll have these live links that you can directly follow to where the resources are shown. And I'm going to be turning it over to Nikki, and we'll take the last 10 minutes of our conversation for questions. So I think I can stop, and then you have, and then Nikki can share. So I'll tell you a little bit of background as Nikki's loading up her screens. But Nikki and I met across the desk, I think in my CPA office in Stroudsburg, and we came to talk business. And somehow we stumbled onto horses. And the next thing you know, we're talking the rest of the hour about horses, and Nikki came and rode with me, and we've been good friends ever since. And then also we've done a lot of work together with other veterinary practices and helped them build wealth, and even some other small businesses that have gone through mergers and acquisitions, and help them have a good retirement. So here's Nikki.
Thank you. Thank you, Holly. It is just a great honor to be here. Holly is one of the best horseback riders in the entire world in the endurance space, which she's not going to brag on, but I get to brag on that. So she's riding 100 miles at a time all over the world and is the best of the best. So she most certainly does bring that to what she does in her business. And I've gotten to see that firsthand with some of the businesses that we've worked on together and the profitability that she's helped to generate for them. So it's a true honor to be here as a panelist, working alongside Holly, a person I genuinely like and truly respect. So with that being said, my name is Nicole O'Malley. I work at Morgan Stanley. I've been there for 15 years. Fun fact about me, I'm a huge animal lover, big horseback rider. I have 2 German short-haired pointers, and I love to play music. But I love to optimize things. I'm a big fan of optimizing anything. So absolutely, wealth, you work so hard for your money. So what could we do to help you optimize that and help your money to work for you? So that's what we're going to talk about today. So let me share my screen here, and we'll be good to go. So, I find that people that work as hard as you do, a lot of money ends up just sitting in cash, mainly because investments are scary or confusing, and I want to demystify it. So we'll go over some, what's a stock, what's a bond, what's going on in the stock market, and we'll take it from there. Please drop some questions in the Q&A. I love questions. So we'll talk for about 20 minutes, and please stop me if you have any questions. So we're going to talk about major asset classes, some just basics, tenets of investing, What is asset allocation and diversification? Okay, so here is the asset class map. We have cash, which is what we were just speaking about, fixed income, which is also called bonds, equities, which is also known as stocks, and alternatives. So cash has a few different buckets. You could have cash just liquid, you could write checks on it. You could have cash in a savings account, which is FDIC insured and earning interest. Right now, we have a savings account that's paying 4% interest. You could lock it into a CD. So that will lock it for a certain period of time. You could do as long as or short as a month. You could do as long as years, 5 years or so. And they'll give you a little bit more interest than you'll see in a savings account, also FDIC insured. So it's like just taking a little step out on the risk spectrum in that you're locking it up. And a little bit outside of that, we'll have treasury bills, which is really short term debt issued by the US government. So just taking another little step out the risk, we'll bump into bonds or fixed income. And so that's when something borrows money and pays you an income stream for that. So that something could be the US government. It could be the state of Pennsylvania. It could be a university or a municipality. Or it could be a corporation like Apple stock or Walmart could be issuing bonds. And then you could go all the way to smaller companies that are going to pay higher interest. They get to be a little bit more volatile, but they do pay greater interest. So when you're building a diversified portfolio, there might be a sleeve in that portfolio for something that's giving you a higher income stream. And then if we're going a little further out, trying to make a little bit more money over time, but also being willing to accept some risk and volatility, we're talking about stock market. And that is actually getting ownership of a company. And this is the greatest way to grow wealth over time. Definitely more ups and downs, but this also breaks down quite a bit. So you could actually be an owner in Apple, you could be an owner of Walmart, and you will benefit. You could be an owner of Costco. That's been a great one to own lately. You could benefit from that company growing. And so stocks will break down to the unit within the United States, within the developed markets, say like Europe, and then emerging markets, maybe like Brazil or India. So they'll also then break down to big companies or large cap stocks, small companies or small cap stocks, and everything in between. And then those stocks will be either labeled value, or they're on sale in comparison to their peers, or growth stocks. They're growing faster than their peers. And outside of all of that, we have alternatives. And I've really, really loved building alternative sleeves lately because stocks and bonds had a little bit of a period there where they're moving together. Alternatives, it's something completely outside the stock and bond market. It's going to be like hedge funds, which is exactly what it sounds like. When you had hedge against something, you insure your risk against it. So they really help to reduce volatility. Could be private credit or companies that aren't listed on the stock exchange that are looking to borrow money to raise capital to grow their businesses. They tend to pay really great income. So I've really been enjoying building out alternative sleeve. Definitely something that you should be considering. So when do you use each? Cash, that's short-term reserves, and it's the money you really want to keep safe. So you want to, and I like to think of your wealth like buckets. You want to have that safety bucket. You want to have a certain amount of income just covered in cash. But you also want to make sure that it's earning as much money as possible. So within cash, you'll have money that's liquid and available. You can write checks on it immediately. You'll also want to have some savings. So it's liquid, usually that day, at least ours is liquid the day that you need it, but it's going to pay you 4%. So you don't want too much sitting in your checking account either. And then if we have some that you're not going to touch maybe for a year or so, let's start looking at CDs and locking in these rates because we're likely, maybe we'll hold rates for a while, but we could continue to lower them if we see some more softening in the economy. So you're going to want to lock some of those rates in certificates of deposits. So that's a really great cash strategy, having a diversified strategy. Fixed income. And so this is also known as bonds. This is especially from 1980 to 2022. It's just we were in a falling rate environment. So, in the 80s, bonds were paying 16% or so, going on down. So, if you were capturing a bond that has a higher interest rate than current interest rates, not only do you get a really high current income, you're going to get price appreciation on that bond. So, we might be in an environment like that again, where we've got rates, around 4.5%, likely to hold here for a little bit, but we're considering, Morgan Stanley thinks we're going to get 2 rate lowerings this year, maybe as early as June. So if rates are now 4, but in June rates are 3.5 or 3, we've got a higher yielding investment here that someone's going to want to pay a premium for. So we're getting a really nice cash flow into the portfolio, and we're looking at price appreciation on that bond. So bonds have a great place in portfolios today. Stocks. You've got to be diversified. I think we could all agree that the world is changing rapidly. So you want to absolutely be diversified. You want to have big companies, but you want to have the up and comers too. It's a dog eat dog world out there. These small companies are getting gobbled up by these bigger companies because it's faster for them to grow that way. So you absolutely want to have a bit of everything in there. Big companies, small companies, everything in between. Europe's been doing great this year. And then emerging economies are quite fascinating. Japan is a leader in robotics. They just went through a 40-year period of stagflation. They're starting to grow again. India, the average age there is 26. They're making quite a bit of money now. They'll be needing to buy iPhones and cars, and it's a very interesting economy. So having a great diversified strategy amongst companies, sizes, and locality, that's how you build a really rock solid stock portfolio. And alternatives. This is kind of a mystical place for people that has become more available to more people just in the last few years. Morgan Stanley has an incredible alternatives platform. If you took our next 6 competitors, you'd still need to multiply them by 200% to get as big as Morgan Stanley's alt platform. We've got availability to some really great investments. And so alternatives are going to be real assets like real estate, gold, energy. You're going to have hedge funds in there. And also another area that I find quite fascinating is infrastructure. So we're all meeting all over the country tonight. And we're doing that because we're streaming on Zoom. We need fast internet for that. We need fiber optic networks. That's what infrastructure is now. It's not just roads and bridges. And that generates a really steady, consistent form of income, and it's a solid spot in your portfolio for the right person. And then private investments. It's going to be private equity. So while the S&P 500 is the 500 biggest companies in the United States, there's also private companies. Most companies in the United States are actually private. And previously, we need to be a pension fund or a big family office to make private investments, but that's been democratized and now it's available to a lot more people. So that's an area that I absolutely love when building out a well-diversified alternatives portfolio. My screen was freezing there for a second. So different ways to invest. Now this goes back to stocks. So actually this could be bonds as well. You can invest in stocks and bonds individually. You could buy the individual stock of Apple and Walmart and Google and Johnson and Johnson. You could buy the individual bonds of any of those companies. Same individual bonds of the United States Treasury or the state of Pennsylvania or Penn State University. Or you could get a group of them. And you could do that a couple different ways through a mutual fund, a separately managed account, or an exchange traded fund. So mutual fund and exchange traded fund are probably the most similar in that they're baskets. And you'll see one line item on your statement. You own ClearBridge large cap growth stock, and then within it, they're buying all growth stocks. The mutual funds have active management on them. They're not incredibly tax efficient. So at the end of the year, they'll pay out capital gains versus an exchange traded fund, which usually seeks to mimic certain benchmarks like the country of Japan or the country of India. And they're very tax efficient. And we're starting to see exchange traded funds that have active management on it. So they're really up and coming. And then actually the most tax efficient way to invest in any of this would be through a separately managed account where you could get active management, but you actually see the individual holdings and you could add tax management to that as well. So basic tenets of investing. This is a chart that's looking at different investments versus inflation. And this is going back 100 years, roughly. So this is going back 1926. So we're going through the Great Depression together. We're going through World War I, World War II, and you name it. We've been through it on this chart. And I really like zooming out and looking at things long term. And so the orange here, this is inflation. The blue is going to be very short, basically cash or very short-term US Treasury bills. We've got a little bit more longer term or intermediate term or longer term here, government bonds, the S&P 500, so the 500 biggest companies in the country, and then the smaller companies. So you can see when we go through a tough time, this is the Great Depression, what better time to look at than that? You could see the smaller companies did the worst, the stocks second worst, and then the rest of it barely moved in comparison. But if you're willing to accept that volatility over a longer period of time, the volatile assets are the ones that are going to outperform. So just getting your mix right is going to be your best bet, and sticking with it. So this is showing you what $1 invested in each one of those would have amounted to over the course of 100 years. Of course, maybe we all don't have 100 years in front of us. Maybe we do with the future of longevity science, but it's really a great example here of zooming out and seeing what it all looks like. I find this chart also fascinating. So this is the power of compounding. So this is 3 different examples of people that invested roughly the same amount of money. So around 123 to 126,000. Alex here, he started and he invested age 30 to 70, 3,000 per month or per year. Jordan is 4,000 per year between 40 and 70, and Taylor 6,000 between 50 and 70. You see Alex ends up with almost $500,000 on his $123,000 investment versus Taylor at 239. And so this is the power of compounding. They put in 300,000, and then that $3,000 earned interest. And then the interest earned interest, and the interest keeps earning interest. And so it really compounds, and it has this ballooning effect over time. So the practice that I've worked in started in the 1960s. So I have many clients that are in their hundreds, and I get to see like what made you so successful. I love looking across the table at those people. What made you so successful? And it was those that paid themselves like a bill. So, taking into account your cash flow and determining what's the best way, how can we optimize this? Let's make sure our cash needs are met. Let's make sure they're optimized. And then what do we do outside of that? And the longer and the more you do that, the better your outcome is going to be. So asset allocation. This chart also was quite fascinating to me. I've been looking. This is a chart that goes back to a white paper written in the 90s, and it's a paper on what makes you successful as an investor? Is it picking the right stock? Is it picking the right stock at the right time, timing the market? Or is it just having the right mix, the right asset allocation? Or is it something that we're not even thinking of? And 91% of your success is having the right mix of cash, of stocks, of bonds, of alternatives, and sticking with it over time. This is fascinating to me. This is a efficiency frontier. This risk is, or this chart here is called. And so it's looking at, lower risk investments, obviously lower return, higher risk investments, higher return, and just knowing how to mix them together in a way that is comfortable for you and where you're at in your lifestyle. That's where the magic is. So this is a great example of what some of our models look like here at Morgan Stanley. So we like to look at risk at 5 different levels. So our most conservative investor and our most aggressive investor, and then that changes. And so this is actually what our portfolios are looking like right now. So our most aggressive investor right now, we actually have at 64% in equity, 26% in alternatives, and 8% in fixed income. So this is the lowest stock percentage I have ever seen Morgan Stanley's Global Investment Committee suggest. And that's kind of twofold. One, the fact that alternatives are now available to most people, and they have a lot of growth opportunity. And then two, the market has run quite a bit. And so instead of maybe having 80 or 90% stock exposure for our most aggressive investor, let's dial it back to maybe like 64, 65% and look to generate some returns outside of that. And then should we get a pullback, I'm going to see this number go back out. And we'll see that across all of the models. So I find this actually quite fascinating as well. I've never seen our stock market allocation that low. So that also speaks to even when things are a bit expensive, it doesn't mean sell everything and run away. There's still some really great opportunities out there. And some of the things that we've mentioned, like Japan and India, some of the value stocks. I mean, Costco, we joke that, did Costco figure out a cure to cancer the way the stock has been moving? So there's some really, really great investments in there that you want in the core of your portfolio. And then we'll add to them as the price dictates. In 2000, right around 1998, 2000, maybe we even go back a little bit earlier to the 90s. We were all getting computers. We were able to email. We're starting to be able to read news on our computer. And we had the .com bubble in the stock market. So anything that had .com after it just ran up like crazy. And that was followed by a significant pullback in the market, about 50%. The market stayed down for about 2 years before recovering to its peak. But then we started to get into the real estate craze and the subprime mortgage craze. And then we had another pullback, the great financial crisis in 2008. So there's this lost decade where if you were only 100% invested in stocks, you made nothing. But if you had a diversified portfolio, like we saw on the previous page, you actually had a 52% return over those 10 years. So this is again speaking to it's really important to have a really well diversified portfolio. And this will be my last chart. This is again zooming out. So this is the stock market, and it's so easy with how we get so much information now on the internet and so much fed to us with news titles. And it's really easy because, if the house isn't burning, people aren't clicking, right? So we're reading a lot of negative news titles. But there's always things going on in the world. So here's the Great Depression, World War II, Korean War, Vietnam War, Cuban Missile Crisis, and people are hiding under their desks. Nixon resigns. We go off the gold standard. September 11th, financial crisis. This is the tech boom and the lost decade that I talked about. Here's COVID-19, and here's where we're at right now. And so when you zoom out, it's all just a little blip in the radar. So keep invested, keep your asset allocation on point, something that you could sit with. Make sure you've got your cash needs met and optimized. And then let's talk about building a really great strategy outside of that. So I will end with that and I'll hand it back to you, Holly.
Great. Thank you very much, Nikki. That's great. I really liked the slide on starting to invest earlier, and that's what we were talking about, which is another conversation. But when to get into investing for your retirement, how do you do that? I try to look for tax deferred opportunities such as, 401ks or simples. And you start earlier, you start with less perhaps than you'd have to as you get into your 50s. You'd have to start investing more. So that's a really good identifier for people to think about it earlier. Thank you very much, Nikki.
Thank you for having me.
So, folks, if there's anybody that would like a free copy of the Vet Advisor, please jot your name into the comments and we'll grab your information from your login, when you signed up for the webinar, and I will mail them out to you. And I have two available, so I'd love to see that. The other thing is that we'd like to open up for question and answer. Well, we have one person that put in for the book. I think you're going to have to give me your full name because I don't have a good identifier based upon what I see on the screen. So please put your full name in either Q&A. Thank you very much. Great. Okay. So from there, how about other questions? I can actually open it up if anyone wants to unmute and take an opportunity to ask a question. See here. I don't see a way to really just do it all in one foul swoop. There we go. Okay. So if you have any questions, you're welcome to unmute your screen and ask the question. Obviously this is probably more of a higher level overview of managing your cash flow and some really good investment tips, because the thing is that a diversified portfolio, having your money in different buckets, and then also I loved the part that you had, Nikki, on the CDs and money markets, because when we're building those cash reserves, those FDIC insured vehicles are good to use because you're not necessarily going to lose principal, but you don't want that money sitting there not making any money for you at all. So I'll open it up to any questions.
Absolutely. And I'd love to offer to everybody that's here a 20-minute ask me anything. So if there's anything that you'd like to go over in your life, I would be happy to do that, complimentary to anyone that was here tonight.
Perfect. Okay, so as I said, we will be sending out the slides to everyone. As you were aware, when we started the webinar, I recorded, and I will download the recording and make the link available. So there are some people that were not able to attend, and I will send that link out. But if you want to share it, please do. And I think we're in good shape. All right. Thank you so much, Nikki. Thank you, everybody, for coming. And hopefully you'll come to our next webinar, which is in April 16th, with Justin Weaver, who is an attorney and has worked with mergers and acquisitions. He's going to be talking about that, but he's done a lot of work with different type of veterinary practice issues. And that's his forte, basically. And he and I actually had worked with another practice that went through a merger, and how that worked out. And he was absolutely fabulous with the paperwork, and we worked with the due diligence as we went along. So I hope you'll come out and join us with Justin, and we'll see you next month. Thank you so much. Thanks, Nikki. Thanks, everybody.
Thank you. Thanks, Holly. Thank you, everyone.
Okay, bye.